Hi, good afternoon, everyone. Thank you so much for joining in. Gurpreet this side from Food and Insurance Brokers. And today's topic is market crash or the opportunity to invest right now. As we all know, the market is really unstable right now, and we have multiple queries going on side by side, whether we should invest or we should not. So, to answer all those queries, I have a very expert with me, Mr. Saurabh Jain, who is an alumni of IBS and St. Xavier's College, Calcutta, and is qualified MBA and CFA, having a decade experience of managing corporate treasury of banks and financial institutions. After gaining rich experience in finance and treasury, Saurabh opted to be a financial advisor and is the co-creator of Debt Totality Game. Currently, he's also visiting. He's a visiting faculty in many MBA institutes of India, such as BIBS, IEM, UEM, ICFAI, business schools, etc. To answer all your queries and to understand this topic better, I hand over without any further ado to Mr. Saurabh. If you have any queries, you can drop it down into the Q&A chat box, and towards the end of the session, we'll take that up. Over to you, Saurabh.
Thank you, Gurpreet. Thank you all the friends for joining in. Again, great initiative by the entire team in terms of connecting and it's more about discussing what's happening in and around, what one should do, what should be the ideal strategy in terms of your portfolio, how you should shape it up, and what are your concerns and queries. Because see what happens sometimes when you are doing investing on your own, so you need somebody to talk to, okay? Because money management, it's something you are doing it. Maybe you have some advisor. So if you have some advisor, either you need a second opinion, or if you're managing it yourself, sometimes we need somebody to talk to in order to understand what is happening, just to have a perspective, okay, and a very independent perspective, what is happening, and based upon that, you can take your call, you can take your stance in terms of how you can shape your entire portfolio of financial planning up. So before I begin, I put a question itself as the topic. What do you feel? Is the crash coming, or is it an opportunity? If someone has a long-term view, maybe 5, 10 years, yes, definitely. If somebody needs money after 6 months, 1 year, for them it has to be a completely different strategy. One needs to be cautious. But yes, if somebody has started investing or is there for last 4, 5 years, but still has a 10-year window. So in terms of how exactly is the opportunity being placed? Come on. So I want all of you to put your thoughts in the chat or the Q&A window. What do you feel? Is it an opportunity, or do you feel is it a crash, or what's your general sense of understanding, your Q&As pertaining to the, I will say, this broad topic? I'll start off with macro, what is happening on the macro level. Then I'll come to micro, I would say domestic perspective. Then I'll give you a perspective as an investor, what you should do, how you should manage your behavior. Okay, because trust me, when I joined this profession, prior to that, my perspective was completely different, just as an investor perspective. But now I know since last 8 to 10 years being here, again the perspective is slightly more, I would say, broad based. It's more, I would say, of a macro than just something if I see in Insta, or if I see some videos, and not to get carried away by those stuffs. Okay, Nilesh says opportunity. It's good send for opportunity. Siddharam says it seems probably it's a crash. Okay, what will be better for more? Yeah, it can be. Let's stick to English, Rajesh, because I know most of the people, sometimes people also join from the south, and for them, I think English is a better medium. So let's stick to English. I think that would be better for everybody. And in between, I can use some phrases in Hindi. That's okay. But I'll try to again do an English version of it. Okay. Earlier invested has the market crashed, whereas investing now has the opportunity. It's an opportunity. Okay, perfect. So again, see, mixed opinion are coming. People who wanted to start, for them it's an opportunity. People who have already started, maybe last 2 years, they have started, and in last 6, 7 months, whatever returns they built up over last 1 year, in last 6 months, we have seen the corrections coming in, and it is, they're not getting that sort of a desired returns, which is there. Okay, need to wait for some time, then it becomes an opportunity. Okay, superb. Yeah, time is really very, very important. Okay, super, great, cool. Yeah, so now just quickly, I'll give you 1 minute time. Please drop in your expectations out of today's session. Okay, because you guys have all contributed your 1 hour. I want all your expectations should be met in terms of your thought process, how you want to take things up, and what are your, I would say, what was the end outcome you wanted out of this session? You want some data to be analyzed and showed to you in terms of, yes, what happens generally when this sort of a situation happens. Okay, two reasons. Yes, one is tariff, another is inflation. Okay, some hedging strategies, superb, already made the bottom, need to see. Okay, superb, great. Great, super. I'm getting very, very, I would say, okay, depends upon intraday, short term, long term. Okay, cool. Yeah. Any thoughts? Come on. Yeah. So what are your expectations? What do you want me to talk about for next 45 minutes? And then, I'll open the forum for Q&A and we can extend another 10, 15 minutes. Okay, if even post session. Okay, index trading for more steady income expectation is that you should do as a small investor. Okay, clarity with our investment. Superb. I think after the session, you will have a lot of clarity, Siddha. Okay, Siddharam, and I think I'll take feedback from you itself. Diversification strategy, superb. Okay, what should be the strategy towards investing into funds? Okay, cool, perfect. Great. Okay, how to spot the multi-bagger SIP, superb, great. Okay, so this session, honestly, we'll not be talking about product specific because it's about a market opportunity or a crash. I'll not talk honestly about what is an SIP and all. Maybe that YouTube, any video you can help you out, or maybe post session you can connect to me. But let me just give you a broad framework what is happening globally. Okay, and why? When I know most of you are investing into Indian markets through an SIP or through your stocks, your stock portfolio is down by almost 25-30%. Your mutual fund portfolio is down by 7-8%. Or even if somebody has been investing since last 2-3 years, your average mutual fund return was 20%. Now it has come down to 13%. Okay, so these are typically 3-4 scenarios where it is there. It is so. It's the name of my firm. Okay, Magnum Finvest. Is the name of my firm. Okay, yeah, perfect, cool. So let me just share one simple instance which is there in terms of highlighting certain stuff. This is the scenario, and this is one particular slide. When you look at it, it covers almost what are the probability, what are the, I would say, opportunities or crashes which has happened in last 20 years, and look at how market has behaved during and post. So this one particular slide will give you a lot of insights in terms of how to manage our behavior, to what extent it can fall, and even if it falls to, let's suppose, an XYZ extent, and then how much time does it take to recover and to come up. Okay, so look at it. Probably all the crises which I could find out, I have pasted everything here. Okay, whether it's a balance of payment crisis which happened in 2019-91 during Manmohan Singh time, when we imported a lot of gold overseas. So we went down by -40, Harshad Mehta scam -54, dot-com bubble -56, and again market sell-off 2006. Again election year, which was there when again Manmohan Singh became the prime minister, and then global financial crisis 2008, and COVID and all those crises. Okay, even you see whatever crisis has happened, yes, market has dipped to the tune of 20, 30, 40, 50, 60. But if you look at the post falling, how much time it has taken to come back. On an average, 1.5 years is the maximum pain point. Okay, in certain years it could be 2 years, but generally 1.5 years is the maximum pain point whenever something extreme has happened. And during COVID, it was very extreme, but again, in just 6 months, it came back very, very strongly. Okay, so this one particular slide will give you understanding. Also, it will give you confidence that, okay, yes, corrections are temporary, but in the long run, if your country as a whole is growing, if economy as a whole is growing, then eventually we will bounce back and we will make it up. So now to give a macro view, what is happening right now, we all know when Trump became the president, nobody expected such sort of a movement. Okay, but US eventually is going under a lot of, I would say, financial stress, inflationary pressure, a lot of loans are there because their loans have simply got escalated over the period, and a lot of internal economic structures are happening. And that's where Trump realized that they need to, instead of just importing certain goods, etc., whatever they are importing from the worldwide, they need to put some tariff structure also in order to earn revenue. Okay, and that's where he started off by putting certain revenues in terms of export and import ratio, which the company is having, because all US also wants their pie, or let's suppose if anybody is selling goods into US, why they should also be taxed. If US is selling to other countries, probably, and just to do the trade, I would say the trade gap or the trade deficit. Okay, and specifically, they are importing majorly heavily from China, and now the US market is to a large extent dependent upon Chinese market for the consumption which their, I would say citizens are doing. You see all the factories of US, they are based out of China, whether it is Apple just shifted to India, but primarily manufacturing happening in China, and all other major, I would say Nike, Reebok, whatever garments, most of them comes from China. Okay, so what is happening? The trade deficit and the dependence on the other countries is increasing, and at the same time, they are not able to earn much revenue. So that is a macroeconomic view which Trump is trying to change by importing certain tariff, and in a way, it is pressurizing other countries to buy something from US also. So that's what India said, okay, I'll buy crude oil from you. And then, my trade deficit gap would reduce, and you reduce my tariff from 30% to 10%, etc. And that's all the entire drama is going on. And all the countries are negotiating with US in terms of maybe, buying and selling, which is happening. So this would certainly help US again, to increase their order book from the other countries, and also this would strengthen dollar, because today what is happening because of US economy getting weaker, there is people are talking about second currency. Okay, and if that happens, then honestly, dollar and US will have a bigger mess in and around. The currency would appreciate further, and this is what Trump didn't want. And based upon, because of that, in order to ensure that the dominance of the dollar remains there, this is a major reason or the major action which is being taken by the government, so that not only they are able to maintain the currency as the, I would say, world primary currency, and also to ensure that the other countries also do buy barter trades from them. So because of that, nobody anticipated that it would happen in a very, very swift manner. And all the other countries, we personally feel US will be able to negotiate except with China. So if you look at it, I can call it as a proxy war between US and China. There is no guns which is being used, but ideally it's more like a proxy war which is happening, because again, he's putting 30%, the other guy is putting 60%. So, it's just, and certainly when they will sit and they will talk, things would, matter on this. If you remember when Trump initially came, he used to have a lot of word of mouth wars with North Korea. But again, eventually something used to happen, and then those guys used to settle down. Okay, so in between this turbulence may happen, but ideally it should get settled down, because Trump cannot continue this, I would say, ups and down. Either he has to implement, or he has to completely delay, or he has to fix a percentage. Maybe I think in next 2 to 3 months, this would get settled down. Next 90 days window is there. So within the 90 days, most of the countries would sit, they would negotiate their trades, and some tariff would come up. So yes, some sector will get impacted, some sector will not get impacted, etc. All those things will happen, but that time will tell whether IT will be benefited or pharma will be benefited, etc. That time will tell eventually. Okay, so this is on the global front which is happening, and because of that, we have seen since last 6 months, October onwards, FIs have been heavily selling, because they knew, somebody knew something is coming. Okay, normally whenever you see any market tend to fall much earlier, and the event happens later, but the falling happens much late, later. That's what happened in 2008-9 crisis, when subprime crisis was about to happen. Even before that happened, we see markets started tumbling down. There was some correction, and after 30 days, the bubble bursted, and so somewhere or the other, people knew some or the other news, and whatever you may call it, and that's how the market behaves. So anybody who has invested since 2023, 24 onwards, started in 24, probably your funds would have been slightly at par, or would have been giving you slightly negative returns. This is quite natural. This has not happened for the first time. If you are doing an SIP, it may happen that probably 2 to 3 years you might have a negative return. But if your holding period is more than 5 years, there is almost 99.199% probability that you will end up making double-digit return. That also I'll show you based upon the past trend and the past history. Now, what is happening in India? Again, last 2-3 days, because of the Pulwama event, Pahalgam event which happened. So again, India, again, the domestic tensions is also prevailing. So earlier Trump tension, probably market has discounted that, market corrected, and then when he delayed by 90 days, market has started to go, started moving up. It feels that more or less that issue will be taken care of. Now the new issue which has come in last 2 days is we are simply on high alert with our neighbor, and we know a lot of actions are being taken. We have stopped the water supply, etc., and all those things which are happening across. And post 1960, this is the first time that the water supply has been stopped. And let's see how far it goes, to what extent it goes. So definitely for this financial year, it is a cautious year. Unless this event goes up, we don't know what is the extent of this particular event, how far our government will go, how far their government will go, we don't know. But again, we need to be cautious. There is no doubt about it. Okay. So short term, if you would ask me, yes, you need to be cautious. If you are doing your SIPs, nothing to worry about it, because SIPs are the product to capture all the highs and lows. If market is only going up, 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 you are doing your SIPs, you will have a higher averaging. So again, your absolute return will come down. But what is happening if it's like a roller coaster ride, then only, it tends to average at a much better level, and you tend to get returns much better in the longer run. So anybody who is doing an SIP, trust me, it's a good year for them. It's a great year, nothing to worry about it. But yes, if somebody has put up a lump sum money and then probably, so still we need to be a bit cautious approach, because of these events which are happening, we could see some plus minus certain things, may crop up. So we just need to be prepared and be very cautious. This is on the macro front and also on the domestic front, which is happening. Now let's understand the mindset or the psychology from an investment perspective. How, as an investor, your behavior should be, because see, you can't control Trump, neither we can't control Modi, and all we can control the our neighbors. So whatever mischievous activities they are doing, and government has to revert. So in between, certain turbulence happens. Okay, let's suppose you have boarded a flight and there are certain turbulence which is there. You don't jump off and fall and up apna seat belt khol ke, you don't jump off. Okay, you fasten your seat belt and you sit tight. Okay, this is the time to sit tight. Why? Because three things which I've learned. If you want to make money in the long run, okay, Charlie Munger has said sometimes big money is made not in buying and selling, but in waiting. So even if you wait and let the dust settle down, and then you will get a lot of clarity. Then Warren Buffett said market is a device from transferring money from impatient to patient. So we need to be patient as an investor, in terms of if your horizon is long term, nothing to worry about it. And again, it will pass by. And last but not the least, which I like by Nick Murray, he said, wealth is not only determined by the investment performance, but by the behavior of the investor. So this is where typically we go wrong and we get carried away by what other people keep saying. Let's not do that. Okay, because every day as a financial advisor, we are managing funds. Some of the other clients keep sharing us some Instagram videos, reels, and based upon that, they really get curious what they should do. See, if those guys are so great, they would have been fund managers and they would have been sitting in their places. But if some, it's like, some people have to come and they have to speak, so they will do that. But our job is to ensure that if you have done your asset allocation well, have you distributed your money into different pockets, how well you are diversifying your money, which is in your control, you focus on that. Don't control much on the external factor. Again, very simple. Okay, look at this one particular slide. This study was being done across worldwide, whether in India also, globally also, where let's suppose if you would look at NASDAQ over last 20 years has given almost 19% CAGR return. Okay, but if you look at returns which the investors have earned, who have invested in those index fund of NASDAQ, they have just earned around 11 to 12% return. Same within India also. You have invested in a mutual fund. All the fund house does their study. Okay, you have invested in a blue chip fund. Last 10-year return of blue chip fund, all the investors who have invested in that fund is around 9%. But the fund has delivered 13% CAGR return. Then why, as an investor, I'm not able to get that return where the fund has actually given the return? Why? Because of entry and exit. Okay, so if you look at a 5-year SIP return of a large cap fund or an index fund, it would have given you 15% return. But if you look at cumulative return of all the investors who have invested during that period, it would be 11, 12 because in between somebody has stopped, somebody has paused, somebody has exited out based upon their requirement, based upon their greed and fear, etc. So because of this, I would say certain factors, investors don't get the return. So what, as an investor, what is in your control is your behavior. You can't control macroeconomic situation. What you can control is your behavior in terms of how you should invest. Okay, this part is clear. Okay, so you know macro, you know the scenario for this financial year. We need to be cautious, but that does not mean that your long-term strategy will get impacted. No. So now, if you will wait that okay, I'll wait for everything to settle down and then you will start. Trust me, you will miss the bus because this never happens. Whenever everything will settle down, even before that, you will see markets will go up and you will miss the bus. That's for sure. Okay, cool. Super. So is this clear up till now? Where is the gap? As an investor, what you need to focus on is your behavioral gap. Okay, to stick to your financial plan. So this is a very natural, question that normally comes to our mind whenever market corrects. So what are the natural questions which is now coming to your mind? Should you stop your investments? Should you redeem it? Yeah, what are the natural questions which is coming to your mind? Come on, yeah. Yes. Yeah, because we all are humans, we all have emotions, and again, we will get all those typical questions. So, what generally could come to your mind? I have plotted it here. Should I stop my investments or SIPs, which I'm doing? Shall I redeem my funds? Shall I buy more, or shall I do nothing? I think these are the only four scenarios which could prevail. Yes. If any other scenario, please put it in the chat. Okay. Okay, what is behavior, investment style, and pay? So behavior is, suppose today market is going up. Are you getting excited and you invest more? Now let's suppose if market is falling down, if you are more fearful, you wanted to pull out. This is your behavior as an investor. How do you behave? Okay, suppose you are in a roller coaster ride. If you are really feeling afraid, you will not jump off. Okay, you will keep fastening your seat belt, and that is what as an investor you should do. Okay, should we diversify now? Yes. So again, this is one question. Yes, and this is there in my content that how you should rate this volatility. Let's suppose you know that certain waves are coming and there would be ups and downs. So how to ride that volatility? Is it good idea to exit and buy a home? Okay. So again, very difficult. If see, home buying is a necessity at this point of time, then definitely if you feel, because normally people, why do people invest? Today, if I'm investing some money because I wanted to buy a car, I want to buy a house, or I wanted to buy maybe for my kids' education, retirement, just as a replacement you wanted to do, having already a house, it doesn't make sense. Because see, if markets will crash, your real estate price will crash more. This I can tell you. Okay, because real estate is a replica of market. First, equity market goes up, then your real estate cycle picks up. So again, it's a link to that. If you think, okay, you will sell equity and you will buy property, then again, it would be another difficult stuff to do that. Okay. So these are typically general questions which comes to our mind. And as a human being, yes, some of you would, somebody who is, I would say, as an investor, he is fearful. Probably, he will invest more. He will continue. Some of you are afraid. Either you will stop or you will withdraw. Okay. But the best strategy, honestly, is, as I said, fear is a very, very natural phenomenon. It's a human being. We will have fear when market goes down. Even if I look at, sometimes there's a big up and down. So we also feel what to do, what not to do, what are steps to do. But imagine if you are in a roller coaster ride. So okay, so whenever you invest into markets, whether you invest into gold, equity, etc., generally the price moves up and down. So it's like a roller coaster ride. So what happens that if you are feeling afraid, you don't jump off. Okay, it's not a good idea because if you put off your seatbelt and if you jump off, it's 100% guarantee that you will lose out. Yes, there's a 100% guarantee that you will lose out. Probably if you will fall, nothing can be done. But again, if you stay patient and if you stay calm, probably the outcome could completely be different. So nobody does this action. Yes, sometimes we feel, but nobody does it. So what is the right strategy? Okay, being seated is the best option. Let the ride get over, and eventually you see when the ride gets over, you feel relaxed and you feel, yeah, dar to laga, but again maza aaya. Okay, yes, there were certain points when you were really afraid and scared, but at the end, you get your, maybe whenever when you did your ride, there was certain objective in your mind and you did that. So what is required? You need patience and discipline. Okay, discipline in the sense you can't open your seat belt, and patience is there that you need to be there, be seated in order to do that. Why I'm telling you? Okay, why I'm telling you? See, what can be predicted? Correction is temporary based upon last 20, 30 years of trend. I can tell you that corrections are temporary in any economy. If your GDP is growing, okay, if you look at your GDP is growing, then eventually it's a growing economy. So there could be temporary correction, but in the long run, growth is a permanent factor which is there. There's no doubt about it. Look at what happened in 1992 when Harshad Mehta crisis, market went down by 54%, but in 1.5 years it jumped up by 125%. Why? Because yes, there was a crisis in between, but overall the economy and the GDP was growing. Okay, again, there was an Asian crisis. It plunged by 30, 40%, 3, 4 years, but again, it went up by 115%, in a very, very short span of time. Okay, very, very short span of time. In 1 year, it went up. So there was underperformance of 3 years. Nothing was moving, happening. But again, when it jumped, it recovered. Okay, in 2000, again, technology bubble went down by 56%. In 2.5 years' time, it again went up by 138%, making up the fall. 2008, lemon down by 61, but again went up by 150%. Okay, and 2016 Brexit happened, and it recovered almost in 1.5 years. Up till this part, I used to run the show during COVID. You won't believe, you can look at my past YouTube videos, up to this particular slide, I have shown during COVID, and I said in COVID has happened, market has gone down by 38% till the month of June. We don't know what will happen. But just based upon the past instances, we used to take a lot of confidence that yes, even though certain turbulence happened, but in the long run, if economy is growing, if the growth is coming back to the economy, market will bounce back. Because when economy is growing, profitability of the company is growing. When profitability of the company is growing, eventually the price will go up, and that leads to markets to go up. So this is a very fundamental rule of investing. Okay, so if you look at it, almost markets recovered in 9 months, almost by 80-90%. And this I've added in this particular slide. Till then, it was a question mark out here. So now looking at the current trend, you may see that in last 6 months, yes, market has corrected, and again it has gone up, and now it may again go up because of the political scenario which is prevailing, I would say. But however, looking at last instances of 10, 15, 20, 30, 20, 25 years, this is quite clear to us that yes, if as an economy we are growing, we'll make it up. That should not be a problem, for us as an economy. Okay. So now I'll give you one option. I'll give you this time machine. You sit on this time machine, and if you get a chance to invest before COVID, will you all do? What would you do? Would you go and invest? Yes, no? Yes, what would you do? So today, if I give you a chance that, okay, please sit in the time machine, I'll take you to March 2022, and then you guys please invest. Yes, will you do? Yes or no? Come on. Yes, all of you would love to do that, 100%. Given the opportunity, yes. If I tell you just go and before, invest in 2008 market, that was a level, obviously. So all past correction seems like a lost opportunity. So today, if I talk to you about the past correction, you might feel, I should have put some money during COVID, or I should have put some money probably in last 2, 3 months when market has fallen down. But all current and future correction seems like a big problem. So this is what behavior is all about. Somebody asked me what is investing behavior, and this is quite natural. I'm not saying that this is something natural. This will happen. Even fund manager, they also have some biasness. Sometimes they also invest in cash. They don't know what to do with the money. So again, but the idea is we can reduce this biasness. So, okay, we know based upon the past trend, yeah, okay, maybe it will take 1.5 years, 2 years. Let's wait on top of it. Let's wait rather than taking some hasty action because everybody is jumping and taking some action. Let's not do that. Let's learn from the past and let's see what we can do. COVID, it was a financial come health crisis. Even that we were able to overcome in next 6 to 8, 9 months. So again, I think this trade and all probably it might stay a bit longer, but eventually it has to settle down. This is quite natural, and I know all of you know it. It's just a matter of time when it will settle down. So that's why I'm saying all past corrections seems like a lost opportunity, but all current corrections, when you see your returns slightly red, we feel it's a big problem and what to do, what not to do. So this is the time where you should review and find out, okay, which are the asset class or maybe which are your investments, which are your funds, which are your stocks have done well even in the bad times. Maybe if market has fallen by 10%, they have fallen by 4, 5%, etc. And which are the ones which have fallen more? Are the profitability of the companies, have turned very bad, or were they all some sort of a news-based stock which you bought it up? So if those are certain, I would say tips-based stocks, then you should exit out. But if the fundamentals are good, if you know that yes, company is still generating profits, the profits are growing, it's just that because the market has gone down, they are down, it's okay, nothing to worry. Hold on, sit on top of it. Don't get carried away by the media, by the noises which are around, because people will be there around you to make some noises. Don't do that. So take a pause. Okay, the best thing is to take a brief pause and then analyze. So these are the returns over last year. Sometimes, people ask me, shall I only invest into equities from a long-term perspective? My answer is to please diversify your money. I think somebody also mentioned asset allocation. So asset allocation is the key to wealth creation. Look at most debt returns which are there. So you should have some money in a fixed income, some money in real estate, some money in gold, some money definitely into equities because they have the potential to beat inflation, and small allocation should also be there into US markets or global companies which is there. Okay, because you look at last 10 years, 15 years, 20 years, all markets have delivered you returns based upon their expectations, based upon their capacity. Okay, so again, you look at all the markets, they have given decent returns, 9 to 10% on an average. Your FD's fixed income average is 7.5%, government bonds which are there. If you look at FD average return, this is there. Okay, so nothing is that, so nothing is good or bad. It's just that when you frame a portfolio, in what percentage, what weightage you give based upon your risk appetite. As an investor, this is something which we all need to learn and practice. Okay, rather than putting everything into one basket and then feeling afraid what will happen and then getting a sleepless night. Yes, you are an aggressive investor, put 60-70 into equities, balance 30%, put it in a fixed income gold, diversify it. This is something which we need to learn, and trust me, if you can do that, then whatever turbulence may happen in next 3 to 6 months, you will ride on top of it. Okay, you will ride those volatilities, you will not have worry, because yes, you have other arms and ammunitions. Like when you need money, gold prices is up, you can sell you can sell gold and you can make money out of it. Okay, and if you have fixed income, now markets are down, you need money, you can redeem your fixed income, your FDs or your PAFs, and you can fund if you need any money. You don't need to be worried about in case of when you need money and during such scenarios. This is the returns which market has given you, okay, over last 30-35 years. Okay, and it has almost grown up by 13.5%. And honestly, this was a return which has come earlier, but going forward, what reasonable return which you can expect is around 11%, because average GDP of India would be 6.5. If you add inflation to GDP, comes around 11.5%. So as an economy, we are growing by around 11% on an average, and that return should translate into your portfolio from next 10 years onwards. This is another interesting number which is there, which will highlight you, okay, what happened when market has gone up from 1980 to 1986. It went up heavily, 450%. It dipped by 40%, and then again it went up. So it just shows you the period of underperformance. So there was a 10 months of underperformance, and again when it went up, there was 4 months of underperformance. in 1992, 90 to 92, there was 2 years of underperformance, 2 years, 3 months. So what we learn from the history that maximum underperformance, which could be there, Kargil and all, everything happened. Maximum underperformance was 2 years, typically, what we learn from the history. Okay, so there could be time when probably 1 year or 2 year market might not perform, might not give you the returns, must be maybe in a sideways phase. So again, you need to digest that fact. Having your horizon is 5 to 10 years, so nothing to worry. And best if you're doing your monthly investment SIPs, again, nothing to worry about it because you're buying every month. Even if you're buying stocks, buy every month, do an averaging so that you get an understanding how things are moving. Okay, this is even very interesting slide. Suppose if some of you have invested just now and maybe in the month of October and after that market has corrected by 20%. Look at even if you have invested during the worst of the time, just before the market crashed, even still today, your position is not very bad. Even if somebody has invested in 2020, just before COVID happened, your market was down 38% in 3 months. What you would have felt that maybe I'm such a bad luck. I invested and mere investment karne ke baad hi market went down. But even if you're standing till today, your average return is 14%. That's not bad as compared to your fixed income and the other your FDs or savings account. Okay, and again look at different scenarios. Even you would have invested before financial crisis of 2008, still you would have been making 9% odd return. Probably even you were least most unluckiest person, still probably your returns would be better off. So yes, there would be certain times maybe if you have entered and post that market has corrected, but again if you stay long, eventually you will get returns out of it, provided, as I said, economy does that. Okay, see, I'm not saying, I'm not framing anything, I'm just giving you the confidence based upon the past instances, because you may not have the data maybe presented in this format that would give you the confidence. Now the best part, most of the, when we do interact with our clients, sometimes people say, let me redeem right now, let the dust settle down and let me invest. Okay, and I think this is the worst mistake anybody would have done. See, maybe you can be lucky once that, okay, you redeem, market corrected, and then you entered, but every time consistently, you can't be lucky. Okay, look at this example. If you have missed out 10 best days in your portfolio, your returns would have been down by almost 50%. And this is actual based upon the actual data. And again, another data which is there to support this, that most of the best days have come during the correction phase, when market is correcting, some global event is happening, etc. And the best phase generally comes. You look at when Sonia Gandhi was being announced as the president, market fell down, and after, suppose you were afraid, you wanted to come out of it, and the moment Manmohan Singh got announced, the market opened up by 20% on the one single day. So you would have missed out that entire bus because you don't know when are the best days, when are the worst days. Okay. So 7 out of the 10 best days occurred during the worst week, when there are certain prices, things are down, and it has happened. So again, normally people say, let me just come out of it. But honestly, it's a very, very difficult choice to do. Maybe once you might be lucky, but consistently you can't be lucky over a period of time. Look at it. If you would have stayed entire period, your returns would have been, let's suppose 10 lakh you would have invested, 2005 value would have been 1.43 crores. But if you would have missed out 10 best days, your returns would have been simply down by 50%. So this shows the conviction, why Warren Buffett says that, be patient, and why Charlie Munger says that, being in the market is more important. Like time in the market is more important than timing the market. Why? Because again, those guys have studied these data, they have actually analyzed these data, and based upon that, they know that maybe once or twice I can be lucky, but consistently, if my horizon is next 10-15 years, I don't need to worry. But yes, if your horizon is next 1 year, then definitely you should pull out your money, because next 6 months to 1 year, we all know it's gonna be volatile. Okay, another behavioral biasness which we all face whenever you see markets are at all-time high. Okay, we really get worried and we feel, yeah, Ravi, though it's a high, let's redeem, let's come out of it. This is what you keep saying across social media, across Insta pages, etc. And then it's the time to correct. See, last 30 years, it has made so many lives high. Probably if any investor would have sold here, he would have missed the bus. Any investor would have sold here, he would have missed the bus. Okay, so every high, definitely it will make new high, it has to go up. Don't look at these numbers, Sensex 132 or maybe 5,000 or 28,000, 80,000. What you should look at it is the underlying. What is the underlying of this is the companies. And what is the underlying within the company is the profitability. So long as the profitability of top 50 or top 100 companies of India goes up, your large caps will tend to do well. So long as the profitability of a mid cap and a small cap company would go up, definitely, they will tend to do well. Okay, so you should focus whether the company is growing, whether the profitability is growing, and if these companies' profits are growing, economy as a whole has to grow. Look at this particular chart. Sometimes when I ask the audience, or let me ask you, which is more risky as an asset class? Come on, what do you feel? Whether FD is more risky or equity is more risky? Yeah, I want an honest opinion. What do you feel? Yeah, come on. Yeah, what do you feel? Equity or FDs or equity, which is more risky? Yes. Yeah, I mean, I think my window is updating. Yeah, FDs, equities. Okay, super. Cool. Equities, okay. So this has always been taught to us. Equity is subject to market risk. Read all scheme documents carefully, okay? But I've shown you in the last 15, 20 years in my first slide, second, I think, just 3, 4 slides before that, if you look at the returns, average in the long run, equities have delivered 13, 14, gold has delivered 10, real estate has delivered 10, and your FDs have delivered 7.5%. So FD is a good product for short term. Honestly, if you need money less than 1 year, 2 year time, please do FDs. That's the best thing to do. But if you need money from a long-term perspective, for 1 year, 2 year, 3 year, 5 years is your horizon, then it doesn't make sense to park money in FDs because you're losing from the day one. Why? Because your expenses are going by 10%. Your inflation on an average is 10%. If I look at what government gives the data and what my lifestyle inflation is all about, my travel, shopping, holidays, if I include, my inflation is more than 10%. Okay, and if my FDs are giving me 6%, 5% after taxes, I'm losing from day one. Okay, so now you look at this chart, you will analyze. So if you look at the data, if I give you a daily return, look at it, you might feel your equity is quite volatile. But if I give you an average return, look at this average return of, if you would have invested for 10 years, 20 years, sorry, 20-year average return from, 2000 to 1980 to 2000, 1981 to 2001, 1982 to 2002. So any average 20 years you look at it, this is the average return which equity has given in the band of 15 to 20%. Okay. So again, from a longer term perspective, equity is one of the decent asset class, nothing to worry about it. See, when you buy any property, even though property prices didn't go up for 4, 5, 7 years, we still not sat on top of it. We are not in a hurry to sell it off. Okay, the same applies with equity. It's a long-term investing. Now, let's suppose if any war-like situation happened, you will not sell off your property. That okay, let's sell off the property and let's sit on cash. बाद में फिर property buy करते हैं. You will not do that. So again, equity is also a long-term asset class. The only thing is that you see the price on a daily basis in front of the screen, and that is what it actually impacts us. And this is what again is behavior. So over a long run, it has provided above inflation return. Long-term expectation definitely should be minimum 10%, maximum depends upon how the economy grows. And again, 30 to 50%, what we have learned, there could be a decline. Probably, what we have seen in the history of the data that whenever markets have gone down, probably this much is the probability it can come down. Okay. Now look at compounding, how your money multiplier works. So very simple. If you perceive 10% growth on your portfolio, this is how your 1 rupee would become. So normally what we feel, my 10 rupee will become 20, 20 will become 30, 30 will 40 if I'm seeing a 10% growth. No, it is not like that. When you do your employee provident fund, your interest also gets reinvested. So today, if you are getting an interest, it also gets reinvested. And again, when you do your equities, your profits get reinvested. When you invest into gold at 40,000, when gold becomes 50,000, you don't pull out the money, that 10,000, you don't sell off that gold, you continue, and then you get a compounding impact. So first 10, if you get a 10% average return, your 100 becomes 110. Then you get 10% return on 110. Your portfolio becomes 11 rupee gets added, it becomes 121. On 121, if you get 10% return, it becomes 12.1. If you add 12.1, it becomes 133. This is how compounding works from a longer term perspective. Trust me, this is in your control. Markets, overall things is not in your control. As an investor, this is in your control. So please look at, always, explore, remember this 732 rule, which I always keep telling. It's a first 7 year is really a painful period when you invest. Okay, because somebody wants to start with 20, 30,000 a month, and if you are expecting a 10% annual return, okay, your first, in order to reach your 1 CR, probably it will take you 10 years. But next 1 CR will happen, in just 4 years. And next 1 CR will again happen in much, much faster pace. So your two would become three in just, 14 years, then 16 years, it will become in 2 years. Okay. So first doubling of your money happens in 10 years, then it takes 4 years, then it takes 2 years, and then 16 to 17 it takes 16 to 18 another 2 years, and that's how your money multiplier effect grows. So initial, when you start your investing journey, your first few years definitely would be a bit painful, but in the long run you will end up making your corpus, provided you sit on top of it. And this is what I said, this is in your control. Compounding, staying disciplined is in your control. So again, take a brief pause. Okay, I think we have learned a lot from the actual data analytics, what should be doing. And this is the reason why I told you to diversify. You look at my first slide when I showed you need to diversify your money into different asset class, because winners keep changing. There are times when gold will become a hero. There would be time when Indian equities would do well. There would be time when US equities would do well, etc. So the idea is to stay invested across different baskets. Again, don't be sector biased that I want to put only in IT, only in banking. You see certain sectors, sometimes they do very well and sometimes they do very, very bad. Okay, look at reality. They did very bad in 2010, 11, 12, 13, 14, 15, 16, and in 2017 they gave 100% return. Okay, this 3 year was good for real estate, but apart from that, look at the 10 years was very, very bad. Again, look at IT. 2020 was good, 20 and 21, but 22 and 23 was very, very bad, not very good returns in those 2 years. Okay, so please don't focus on sector specific. Do your asset allocation. 70% equity if you want an aggressive investor, 15 gold, 15 debt. This is the average return which you can certainly expect in last 10 years time, 12%. And if you put a 50-50 weightage, again your returns will not differ much. And again, if you are a conservative investor, 30-40 equity, balanced debt and fixed income, probably this is the last 10 year, 15 year, 20 returns. Okay, Nifty, we have just taken Nifty 50 return. We have not added mid caps and small caps, so we have just taken a Nifty 50 returns just for a better comparative perspective. Okay, cool. So asset allocation is very, very important driver from a long-term perspective. And this has been my learning that whenever there is volatility, you should diversify your money into different asset class, and this will help you in terms of understanding. Okay. So this is a book, friends, which I have authored. If some of you love reading it, you can catch hold of it. Now I'm okay to answer all your questions, which is there in the chat. Let me look at the chat window so as to give you a perspective in terms of how we can. And now it is up to you to judge whether it's a crash or it's an opportunity, or if you are invested, should you be patient enough to take care and ride on top of it. Is debt fund better? Almost similar. Now there's no point, not much of a difference between debt and FD, almost similar. Chinese market, particularly in sectors of manufacturing, technology, consumer, has maintained growth since 20 years. See, China, there's a different problem. The problem is not with the economy or what they are doing, but in China, the problem is with the governance and the transparency. Okay, people are really afraid post-COVID because the way they have hide a lot of facts, and they a lot of manipulated, a lot of hijack, a lot of technology. They tend to steal rather than doing a collaboration with the other countries. That is the main problem with the China. So it's not the issue with the economy is not doing good. Major issue is with the trust issue. that people don't trust China as an economy. That is a major problem with Chinese as an economy. Okay, perfect. Yeah. So can we buy gold now? Yeah, you can buy gold, but don't buy at one go, because see, gold is definitely a good asset class when this turbulence comes up, but please buy in phases. Buy every month through a SIP format. It's a very good way to invest, but don't buy at one go. US, you can invest either through a normal, Indian mutual, like through a mutual fund route, but currently RBI has paused it. So just wait for some time if you want to invest through a mutual fund route, or let's suppose if you want to invest into US market, then you have to open a direct demat account with them, so that you can have access to that particular stuff. Okay, sharing my in the chat box, I'm sharing my LinkedIn Connect. That is where I'm quite active, and we can stay connect. We can be connected if you have any other queries, and also some of you are asking for the deck. I'll share this one particular form is there. Okay, it's a very simple one, question bank. Once you just share your details, it's like a simple link or a feedback form which is there. So once you drop in your details, we'll be we'll share the form, this PPT with you. That's not a problem. I know it has a lot of good data, and these data are all available in public domain. It's not something which I've taken. So if you need the deck, no problem. You can just drop in your details in that feedback link which I've shared. So I'll share it with you. That's not a problem. Okay, how can we invest in index fund? Very simple. Either you can buy an index fund ETF, or you can do through a mutual fund route. If you want to buy on a monthly basis, Manoj, you can simply create your KYC in a mutual fund and start investing in Nifty 50 fund, Nifty mid cap index fund, whatever funds you want to do. You can do it very easily. It's a very simple thing. Best thing, you can just do a Google and you will find out good, very simple videos. Or if you need any assistance, we can help you to kickstart your investments. That's not a problem. Lump sum investment, not at this point of time, Meena. I think let's avoid. Probably if you would have asked me last week, I would have said yes. But because of the new development which has happened, with our neighbors, the kind of tensions that we are building, avoid. I feel, if government takes some very bold step, probably market can slightly correct from here. So just wait. If you have money, it's good. It's good to hold right now. Just wait a bit. In terms of gold bond, yes, gold bonds, government has stopped it. SGBs are no more there, so you can invest in gold ETF, or you can do into gold ETF either directly or through a mutual fund route. Is it good idea to invest in Dubai real estate? Yeah, economy of Dubai, see, honestly, is doing quite good. The no taxability is also not there. It is considered as a safe haven. So if you are getting an opportunity, definitely you can invest there. There's no problem. Not from a perspective of price gain, but yes, from maybe in future, if you get a good rental income opportunity, that's also a good option for them. Okay, SBI Magnum Mid Cap, yes, is a very, very decent fund. You can hold on top of it. It is advisable to, just a second, I lost some questions in between. Okay, is it advisable to invest in PSU funds? So again, don't be sector specific or a PSU specific. This is why I've shown you in my chart. See, last 1 year PSU, last 2 year PSU did very well. So in my view, if somebody does very good in last 2 years, it will not do good in next 1 to 2 years. So avoid PSUs right now, because PSUs and defense have really done good. Wait for some time. Better to invest in a diversified basket where you have PSU, private, everything. Why to stuck yourself in a one particular segment? Okay. Can we use to invest? How can we invest in foreign funds? As I said, simply you can open a demat account through your HDFC Bank, ICICI Bank. They will help you to open an overseas demat account with a global broker. You can do that, or through a mutual fund route, you can simply invest in the index fund. So if you want to buy direct shares of Apple and Google, you need to open a demat account. But if you want to invest in, let's suppose, Nasdaq, S&P fund, then you can do through MF. But MF route is temporarily paused. Let's wait for some time. RBI will open it. Okay, is it good to stay in India and move abroad considering the tax? So again, it depends upon which country you move abroad. Okay, so if long run you are planning to shift because of maybe your kids are there, they're settling down, and post retirement you need to go there, you can. There's no problem. So you need to work out on your personal basis. I would say your overall family in terms of your overall logistics. Because sometimes people, they go abroad, they don't feel there's no social circle, and they again want to come back to India. So again, taxation cannot be the only issue. You need to look at your social burden. If anything happens there, who will take care of you? Here you have a lot of your neighbors and maybe your relatives to take care of it. So a lot of things you need to work out. So again, thematic, personally, I feel one should avoid. But yeah, when you talk about manufacturing, it's not about one particular sector. So there your money goes into different sector. It goes into textile, it goes into, I would say, pharmaceutical. It can go into every sector except IT and banking. So it is okay because long run government push is there on manufacturing. We can do that. Again, within being a recorded session, I can't tell you any specific fund name of the fund. So you drop in your details in the feedback link, which is there. And once you submit it, automatically you will get an option to schedule a call. You'll get access to my calendar. So there I can help you out. That's not a problem. Again, which SIP is the best? Honestly, there's no best SIP. Today, what is best? If you look at the data next year, definitely it will not be best because वो best last 1 year में best दे चुका है. Again, if you look at the study, very few, rare you might find that something which is best stays there for more than 2 years. Generally, the cycle turns around. So choose funds which are more consistent, which have fallen less during those volatile times. Those are the way to select funds. Okay. I've already shared the link in the chat. So if you have not got the link, maybe I'll just share it in this here itself. So very simple. Let me just share this link for Excel. Let me just write it. Okay, and I've sent it to all. So I put it in the Q&A window also. So you can just utilize this, fill your details, and you will get it. In the last chat, of Abhishek, I have added that. I have 8 ETF, one in US, one in gold, one in silver, Nifty Bs. It's good. I think your portfolio is fairly diversified. You don't need to worry, Abhishek, at all. Small and mid cap, please avoid Ravi at this point of time. Honestly, I would say because small and mid cap is overvalued. If you're already investing, your SIPs are running, it's okay. But if you want to start new, avoid at least for some time. That's what I feel personally, because generally when you see, global tensions are happening, etc., mid and small will take time to go up. Your large will go up first, followed by mid and small. So if you want to start an SIP for next 10 years, still you can do. But however, if your horizon is just next 1 to 2 years and you feel okay, they have corrected, they can correct more. So if you are putting money, put with the intention that okay, they may correct some more. So be prepared for it. If you are okay with it, then you can go. Flexi is a good option, definitely. Rather than Flexi, personally, I choose a large, a mid, a small, or Flexi or a multi as a strategy. But again, having said that, in this particular scenario, yes, when there is a volatility, Flexi is a good option because fund has an option to shift to a large cap, looking at the current trend in the scenario. Okay. If you can tell me what are the keywords to search. So again, Tanuj, you look at, as I said, look at certain funds. I'll just give you one example. Suppose you want to choose a large cap fund. Okay, look at what is the category average. Suppose in that large cap, there are 10 funds. What is the average performance of those 10 funds? And let's suppose now if you're choosing Axis Blue Chip Fund, look at the performance of Axis Blue Chip. Or look at, you are choosing ICICI Blue Chip Fund, look at the performance of ICICI Blue Chip, whether it has performed better or worse than those category average. So this is a process which eventually we find out, curate the funds. Very simple. We take the category average. If I'm taking a mid cap, there are 20 mid cap funds. What is the average of all those 20? Okay, the average comes 15. Which are the funds which are given more than 15? 3, 4, 5 funds we filter, and that's the best way to select. Okay, see, earlier we used to name funds, but now being a recorded session, as per SEBI guidelines, we are not allowed to name any specific funds. That leads to promotion, and and again we are being penalized for that. Okay, I'm a regular investor since last 10 years. I'm patient investor and not in a hurry to withdraw. Okay, superb. But my question is, how do I get maximum gains? So again, if you are there in last 10 years, Pradeep, I can tell you, even after this fall, your portfolio is yielding you 14-15% return. Okay, now how to capitalize this fall? Yes, when markets are down, you can do some top up. Because as an investor now, you have become a matured investor. You have seen 2-3 ups and down cycles. So you know that even if certain fall happen, okay, it is temporary, it will go up. So for you, Yes, I know you will have the guts. So now if markets are down, take some opportunity and do some top-ups in between. Okay, how do I search folio with AMC if say Demat account? So if you have a in Demat account, there's no folio. You need to go with the Demat guy, and he will give you the details. So that is the reason for mutual funds. We always recommend to have a direct, association with the mutual fund company. You don't need a Demat account for mutual funds. So why to go through a Demat route? You can simply, open it directly outside. There is no problem. Simply invest into mutual funds without a Demat account. I had bought RVNL at 25, it became 25x in my portfolio, now it is 15x. Yeah, see, don't look at lost opportunity, Anand, because when you invested, you never thought it will become 25x. Okay, you never thought. Maybe you were thinking even if it become 2x, it is okay. So now even if it is 15x, it's a good number. So I would advise you in such a scenario, anybody who is having it, at least book partial profits so that you know that yes, you have made some money out of it, and then later on if you get an opportunity you invest, or if you find a better company at this point of time you invest there. But booking partial profit is always advisable, because you never thought it will go up to 20 times. So now even if it is 15 times up, we should be very happy. Different ways to invest in gold: physical gold, buy jewelry if you love, there is no problem. Or if you want to buy a gold ETF through a mutual fund or a broking stock, but where you have a demat account, you can do that. These are the two best methods to buy gold. So if you buy in a digital format through a gold ETF, after 2 years, if you even if you sell, your capital gain tax will be just 12%. So that's the best way from a long-term perspective. Okay, any ideal distribution uh, weightage for a large mid cap, small cap fund? So almost 40, I would say 40% should be in a large cap fund. 40 to 50% is good to have in a large cap fund. 20 into mid, 20 into small, and 10% can be in a debt fund, where in case of any emergency you can pull out. So 40, 20, 20, 10 is a good option. Okay. Is it good to invest in digital gold rather than gold ETF or physical gold? Is it good to invest in digital gold? You can do that. There's no problem. So there are certain PTMs, or I would say your PhonePe, they offer you some digital gold. It is okay. There's no problem. But again, having said that, it is always advisable. Just check whether they're SEBI regulated or it is RBI regulated. Just check that. That's the only thing which I tell you, to be, because when you invest through a mutual fund or through a stock broking route, when you buy ETF, it is SEBI regulated. Okay, when you buy physical, again you get the emblem wherever you are buying, whether it is Bangalore Refinery or through a Tanishq, etc. So I'm not very sure whether those all digital gold who are selling, whether they are allowed or certified, or they are SEBI registered. Just check that. I have started my SIP per month. Shall we add? Every year you should add some of the other investments. Okay, maybe this year you want to add some money to equities, markets are down, you do that. Next year you wanted to add some SIP, maybe in your gold, which you are buying, you do that. Then you want to add something to your employee provident fund, you want to increase, do that. So again, have an allocation. As I said, asset allocation is the key. Have something in your fixed income, something in gold, something in equity. That's the most profound strategy, because you don't know what will happen in next 10 years. See, only problem with crypto is that the reason why I don't recommend anybody to invest, because it is not regulated. इसका यही सबसे बड़ा problem है. Tomorrow I'm investing in a crypto, and let's suppose if that app crashes, or maybe there is some scam happening, I lose out the money, and either I can go to RBI or I can go to any regulator and complain. That is a bigger problem. So please be aware of it. Regulatory risk is one of the biggest risks which we try to ignore. Please understand this. As an investor, a lot of people have burned their hands earlier, but please understand, regulatory risk is one of the biggest risks. Tomorrow, if government comes and change the regulation, the entire sector just goes off. So again, crypto, nobody is regulating. That's the biggest risk. Okay. My father sold some land, and in current scenario, balance fund is really very good. You can put money in a balance fund and you can take SWP. That's a very, very good strategy. Balance fund or a multi-asset, because multi-asset now has a mix of gold, debt, and fixed income, which I was just telling you. And going forward, if next 4 years till the time Trump is there and we see these sort of a volatility, and then gold may do well as an asset class.
Hi, Saurabh
Okay.
sir. Shall we just take last question because it's
Yeah,
already
just one
4
question.
of 6?
I'll just quickly. Whether stable
Hi.
money again, these stable money and all, honestly, they are not very stable. RBI has already closed, have shut down all these, a lot of these P2P companies, they are really struggling. So honestly, I'll not advise you to do just for 1% extra return, 2% extra. To put your capital at risk, it really becomes very difficult. I know certain P2P companies like stable money, they're not even able to repay right now. They're in a very, very bigger mess. So again, please, I would say, avoid see, when you take a risk, look at the returns, what you are getting. You're putting your entire capital at stake just to earn 1% extra return. Is it advisable or not? So I think that's a matured call as an investor, which you have to take. Okay, so I've shared the details again in the chat window. If you would look at it, there are my LinkedIn detail is there, and I've just shared that form, a small detail form. So you just, all of you have dropped in the details. I'll share this deck with you. There's no problem. And again, once you fill it, you will get an option to connect. If you have any personal specific question, one-to-one question, so we can connect for that. That's not a problem.
Thank you so much, sir. Thank you everyone for participating and giving these wonderful questions to answer queries that came across. Be safe investor, as Saurabh sir always mentions. He's there to guide you. If you have any queries left, as he's mentioned, please connect with him directly and he'll be able to help you across. Thank you, everyone. Thank you, Saurabh sir.
Thank you. Thanks, Gurpreet. And thank you all the friends for joining in. So there were 500 plus in numbers. So I'm really happy that, most of the investors were there. And today I'm happy that I'm able to answer all the questions which were there. So thank you. Thanks a lot.
Thank